Kevin Spacey.
And you're selling something that you know has no value.
Demi Moore.
No, don't get me started. We discussed this.
And Captain Spock.
Excuse me?
I'm Peter Bielagus, and this is Money in the Movies. Hello and welcome to Money in the Movies, a show where we review films based on their financial accuracy. Today's movie is Margin Call, directed by J.C. Chander and starring Zachary Quinto, Kevin Spacey, Demi Moore, Penn Badgley, Jeremy Irons, Paul Bettany, Simon Baker, and Stanley Tucci. Okay, first of all, let me just say this film rocks. We review a lot of great movies on this show, but this is a great movie that a lot of people missed. The film takes place over just one night when risk investment analyst Captain Spock discovers that the investment firm that he works for is in big financial trouble.
Is that figure right?
During the housing boom that came crashing down in 2007 and 2008, many Wall Street firms were highly leveraged. Leveraged is simply using someone else's money as your own. As an example, when the housing bubble of 2007 began to burst, the brokerage firm Lehman Brothers, which had been around since 1850, was leveraged more than 30 to 1, which means for every $1 they had in their accounts, they had borrowed 30 from someone else. When people or businesses borrow money or leverage themselves, the lender always wants to know one question: will you pay me back? Borrowers answer this question in two ways. One, with their financial reputation, and two, with collateral. An individual person would show their credit report and their credit score to prove their financial reputation. And a business would show its business credit score and its financial documents, such as its balance sheet. Collateral is simply something of value that a lender can take if a borrower doesn't make his or her loan payments. When an investment firm trades on margin, that means it is conducting a good portion of its business using borrowed money. A margin call happens when a lender gets nervous and demands more collateral. Many loans on Wall Street are not the long-term loans that consumers have on their houses and cars. Some Wall Street loans, known as repo loans, are loans for billions of dollars for just one day. But wait a minute, why would a lender make a margin call? Well, remember, lenders always want to know, will you pay me back? And borrowers always answer that question in two ways: financial reputation and collateral. If a firm's financial reputation starts to head south, or if the object that it put up as collateral starts to go down in value, lenders will make a margin call, saying either give me more collateral or just pay me back entirely. The investment firm in the movie, like most Wall Street firms, was borrowing a lot of money to buy home loans and merging them together into one big pie. The firms would then cut that pie into slices called tranches. Those tranches contained a little bit of each home loan in the pie, so a buyer would have a tranche that would have some risky home loans and some safe home loans in their tranche. The idea was to spread out the risk. Since the tranches contained home mortgages, they were called the now dubious mortgage-backed securities. But selling these was a game of musical chairs. Around 2007, the default rate on home loans, in other words, the number of people who said, I can't afford to pay this, began to creep up. Investors no longer wanted to buy the tranches because they became worried about the default rates. Financial companies found that not only did they have something they could not sell, they had something that they borrowed a lot of money to buy themselves. The lenders of that money began making margin calls once they realized their buyer's collateral wasn't as valuable as it appeared. In the film, Captain Spock figures out late one evening at work, and he tells his coworkers what he found.
What Eric was trying to do was to work these numbers for levels of volatility that fall outside of the standard VAR model.
What are those levels?
It's fairly complicated.
Eventually, he finds himself explaining the musical chairs problem to the boss of it all, Jeremy Irons.
If those assets decrease by just 25% and remain on our books, that loss would be greater than the current market capitalization of this entire company.
Jeremy Irons makes the brutal decision to sell off all of their toxic assets as quickly as possible before the rest of Wall Street realizes what has happened. He summarizes his strategy in this wonderful line.
There are three ways to make a living in this business. Be first, be smarter, or cheat.
The next morning, when the financial markets open, the company sells everything it can as fast as it can before anyone else on Wall Street can figure out what they're doing. The firm takes heavy losses, but they do it
So that we may survive.
In terms of financial accuracy, the film does portray the gamble that Wall Street made on these home loans, foolishly thinking that the good times would never end. The largest Wall Street firms, like Morgan Stanley and Merrill Lynch, came very near to going bankrupt. One firm, Lehman Brothers, actually did go over the edge, filing for bankruptcy on September 15, 2008. Another large Wall Street firm, Bear Stearns, was bought by J.P. Morgan for only $10 per share, when it was trading as high as $133 per share just a year earlier. In terms of a firm unloading assets that they knew to be toxic, well, the Australian hedge fund, the Basis Yield Alpha Fund, accused Goldman Sachs of selling investments that it knew to be worthless. The lawsuit is still pending as of the date of this filming. Goldman Sachs did pay a settlement to the Securities and Exchange Commission, the organization that regulates these investments, of $550 million in 2010 to settle claims that it misled investors in selling them mortgage-backed securities that turned out to be worthless. Now, though Goldman Sachs agreed to pay this money, which, by the way, was the largest settlement in the history of the Securities and Exchange Commission, Goldman Sachs did not admit to any wrongdoing. Margin Call does an excellent job of capturing just how far Wall Street went during the housing boom of the new millennium, and the financial and moral consequences that went along with it. Therefore, I give the film 3 out of $3 signs. I'm Peter Bielagus, and this is Money in the Movies.